December 9th, 2024. Oracle Corporation releases its fiscal 2025 second quarter earnings. Revenue comes in at $14.1 billion. That's 9% year-over-year growth. On paper, respectable. On Wall Street, not enough. Analysts had expected slightly more. The stock drops over 6% the very next trading day. Headlines flood the financial media. Oracle disappoints. Cloud growth slowing. Hyperscalers intensify competition. Spreadsheets light up. Models get adjusted. Price targets move down. And almost everyone misses the only question that actually matters. Why is one of the fastest growing AI infrastructure companies on Earth suddenly unable to scale capacity when customer demand has never been stronger? That question changes everything. Because Oracle isn't stumbling due to weak demand. They aren't losing customers. They aren't being out-innovated. They are constrained. Physically constrained. Oracle cannot deliver the infrastructure customers are desperately paying for right now. The bottleneck is not semiconductors. It's not engineering talent. It's not Amazon Web Services or Microsoft Azure stealing contracts. The constraint is something far more fundamental. Something every technology giant on Earth is colliding with simultaneously. Electrical power. More precisely, the electrical grid's inability to deliver continuous megawatt-scale power to AI data centers that operate at maximum load 24 hours a day, 7 days a week, 365 days a year, with zero tolerance for downtime. This is not a temporary supply chain issue that resolves in 2 quarters. This is not a software bug you patch. This is physics colliding with Wall Street's growth expectations. And when that collision happens at global scale, entire investment theses collapse overnight. Listen carefully to what Oracle as CEO said on that December 9th earnings call, because the wording matters. She stated plainly that Oracle did not bring online as much cloud capacity as they could have deployed and monetized during the quarter. Not because Oracle ran out of capital. Not because NVIDIA failed to ship enough H100 chips. Not because demand softened. Because Oracle faced a choice. Build smaller facilities they could power immediately and recognize revenue. Or proceed with much larger AI infrastructure builds and wait months or years for sufficient power capacity to become grid available. She used the exact phrase, "Power capacity is the constraint." That sentence should have shaken markets. Instead, it was ignored. One of the most valuable technology companies on Earth is being told by utility providers, in effect, "We'd love to help you. Come back in 5 to 7 years after we rebuild the grid." In an industry where AI capabilities double every 6 months, that delay is not inconvenient. It's existential. Today is Saturday, December 14th, 2025. Silver just traded at $62 per troy ounce, holding near all-time highs after an explosive year. To understand why these two facts are connected, you must understand the engineering reality Wall Street never bothered to model. And that begins with a single chip. To understand why Oracle hit a wall, you need to understand the machine powering modern AI. A single NVIDIA H100 GPU, the exact silicon running ChatGPT, Claude, Gemini, Grok, and virtually every frontier model you've interacted with in 2025 draws 700 watts of continuous electrical power, not peak load, not burst demand, continuous steady-state power, every second, all day, forever. That is roughly the same as running 7 high-performance gaming PCs simultaneously and never turning them off. No sleep, no maintenance window, no pause. Now scale that. A moderate AI training cluster uses 10,000 GPUs. 10,000 times 700 watts equals 7 megawatts of uninterrupted power. That is enough electricity to continuously power 5,000 American homes running air conditioning, heating, refrigeration, lighting, televisions, everything, at peak load. And that's just a moderate cluster. Oracle is currently building facilities designed for 65,000 GPUs and publicly planning deployments exceeding 130,000 GPUs using NVIDIA's upcoming Blackwell architecture. We are no longer talking about buildings. We are talking about small cities. Except cities don't behave like AI data centers. Cities sleep. Cities slow down at night. Cities reduce load on weekends. AI training clusters do none of that. They pull maximum rated electrical load every single second without variation, because interrupting a multi-million-dollar training run mid-execution destroys weeks of computation and burns millions of dollars instantly. This is where the infrastructure crisis becomes unavoidable. The United States electrical grid was largely designed and constructed during the 1970s. It was engineered for suburban housing developments, shopping centers, office parks. Traditional manufacturing plants, factories in that era ran day shifts, powered down overnight, shut down on weekends. The grid handled that beautifully. Predictable, intermittent, distributed demand. AI data centers represent the exact opposite of every design assumption. They require 24/7 operation, no downtime, no load variability. Massive localized power draw when Oracle, Amazon, or Microsoft approaches a regional utility in Virginia, Ohio, or Texas and says, "We need 10, 20, 50 megawatts of continuous power, starting now." The response is brutally simple. We can't deliver that reliably with existing infrastructure. Substations aren't rated for it. Transmission lines can't sustain it. Transformers overheat under continuous maximum load. So utilities respond with the only answer they have: "We can support you." After regulatory approvals, environmental reviews, financing, construction, and grid upgrades. Timeline? 5 to 7 years. In AI time, that's an eternity. This is why Oracle's cloud revenue, despite posting 33% sequential growth, still disappointed investors. Because demand is not the problem. Contracts already signed. Money is already committed. Meta needs compute. NVIDIA needs internal research capacity. OpenAI is starving for training infrastructure. Elon Musk personally requested more AI capacity than Oracle could physically energize. Larry Ellison said it outright. The chips were available. The engineers were available. The electricity was not. This is not an Oracle problem. This is a hyperscaler problem, a national infrastructure problem, a physics problem. And it forces every major technology company to confront the same question at the same time. How do you power the AI future when the grid cannot support it? Once the grid fails, every hyperscaler reaches for the same idea: energy independence. If the grid can't deliver reliable power at scale, then the data center must generate, store, and control its own electricity. That sounds simple. It isn't. Every traditional backup power solution breaks down the moment you scale it to AI data center size. Solar doesn't work. The sun disappears for half the day. AI training jobs do not wait for sunrise. Wind doesn't work. Sometimes there is no wind for days. You can't tell enterprise clients, "Sorry, your model stopped training because the atmosphere was calm." Natural gas turbines technically work, but they ramp power far too slowly to respond to fluctuating computational loads. They're built for steady industrial demand, not millisecond-sensitive AI workloads. Diesel generators are reliable, briefly. They were never designed to run continuously as a primary power source. They're expensive, polluting, and politically unacceptable at scale. Nuclear would be perfect. But nuclear takes 15 to 20 years to permit, site, construct, and license. AI needs power now. That leaves only one viable path forward: massive energy storage. The ability to absorb electricity when it's cheap and available, and release it instantly, at full power, whenever the data center demands it. To work at hyperscale, that storage must operate 24/7 with zero failure tolerance, scale from megawatts to gigawatts, last decades, not years, avoid thermal runaway and fire risk, require minimal maintenance, lithium-ion batteries fail this test. At grid scale, lithium systems carry catastrophic fire risk. Utilities and insurers know it. Regulators know it. Hyperscalers know it. So the industry has quietly pivoted toward flow batteries, specifically zinc-based and nickel-zinc energy storage systems. These batteries do not burn. They do not explode. They scale efficiently. They can cycle for decades. And in late 2024 through 2025, they move from experimental to deployable. This is where the story shifts sharply from cloud computing to industrial metals. Because while these battery systems don't use silver as their primary storage medium, they rely heavily on zinc and nickel. And here's the connection Wall Street missed. Roughly 70% of global silver production is a byproduct of mining zinc, lead, and copper. You don't mine silver because you want silver. You mine zinc, and silver comes along for the ride. When zinc demand explodes, mining economics change. When mining economics change, silver supply changes. Now layer in reality. Silver is already in deficit. Before AI energy storage entered the conversation, the silver market was under extreme pressure. Now it's facing a structural shock because data centers don't just need batteries. They need silver everywhere, every server, every switch, every power distribution unit, every cooling system, every high-current electrical contact. A single hyperscale AI data center contains hundreds of kilograms of silver embedded permanently in infrastructure that will not be dismantled for 20 to 25 years. If just 100 major AI facilities are built per year, a conservative estimate, that alone locks away roughly 1 million ounces of silver annually. That's an entire mid-sized silver mine. Gone. And this is happening at the same time 3 other massive industries are already draining supply. Solar, electric vehicles, 5G infrastructure. Which brings us to the hard numbers Wall Street refuses to confront. As of mid-December 2025, silver is trading near $62 per troy ounce, hovering just below the all-time high reached days earlier. That price move shocked most investors. It shouldn't have. Silver began 2025 near $29. It's now up over 110% year-to-date, dramatically outperforming gold. Historically, silver almost never does that. Gold leads. Silver lags. But 2025 broke that relationship because silver stopped behaving like a monetary metal and started behaving like a critical industrial input with no substitute. Global silver demand in 2025 is tracking toward approximately 1.3 billion ounces. Global mine production? About 840 million ounces. Recycling adds some supply, but not nearly enough. The math is brutal. The world is consuming hundreds of millions of ounces more silver every year than it can produce. That gap is being filled by draining above-ground inventories. Stockpiles built decades ago when supply exceeded demand. Those buffers are disappearing. COMEX warehouse inventories in New York are falling. London vault holdings are shrinking month after month. Shanghai inventories are declining. We are burning through the last shock absorbers of the silver market. Why is demand so extreme? Because 3 massive industries all expanded at once. First, solar energy. China alone installed over 250 gigawatts of new solar capacity in 2025. Every solar panel requires silver conductive paste. And as panel efficiency improves, silver usage per watt actually increases, not decreases. Solar now consumes nearly 20% of global silver demand, up from just 6% a decade ago. Second, electric vehicles. EVs use far more silver than combustion vehicles in motors, power electronics, charging systems, and battery interfaces. China now produces more EVs than the rest of the world combined. That demand is structural. It does not reverse. Third, 5G infrastructure. Global 5G deployment is only 20 to 30% complete. Every base station, every router, every switch requires silver for conductivity and thermal performance. And now we add the fourth demand shock: AI data centers and energy storage systems. Even conservatively, AI infrastructure expansion alone consumes millions of ounces per year, permanently locked away for decades. Against this demand, supply is rigid. Silver is not primarily mined on purpose. About 70% of production is a byproduct of mining zinc, lead, copper, and gold. You cannot simply turn on silver production. When copper prices fall, silver supply falls. When gold mines shut down, silver disappears with them. Primary silver mines face declining ore grades. 20 years ago, 15 ounces per ton was common. Today, 4 ounces per ton is considered decent. That means 4 times more rock, 4 times more energy, higher costs, tighter regulations, longer permitting timelines. Many miners now face all-in sustaining costs approaching $40, $50 per ounce. That does not incentivize rapid supply expansion. Recycling won't save the market either. Gold is recycled at approximately 90%. Silver is not. Silver is dispersed in microscopic quantities across billions of devices: phones, laptops, servers, solar panels. Recovering it costs more energy and labor than the metal is worth. So it goes to landfills, buried, lost, and battery systems. They won't be recycled for 20 to 25 years. Any silver installed today is removed from circulation for an entire generation. Which brings us to the unavoidable conclusion. At some point, every commodity market faces the same law. Total supply must equal total demand. When it doesn't, price becomes the weapon that forces balance. Silver is now failing that equation. Total annual supply, mining plus recycling, is roughly 1.05 billion ounces. Total verified demand, industrial use alone, is approaching 1.4 billion ounces and rising. That gap is not theoretical. It is real. It is happening now. Solar needs silver. EVs need silver. 5G needs silver. Medical equipment needs silver. Defense systems need silver. AI data centers need silver. There is no substitution. There is no workaround. There is no software patch. And if industrial demand alone begins consuming the majority of available supply, silver ceases to function as a freely traded monetary metal. It becomes a strategic industrial resource, reserved for governments, reserved for hyperscalers, unavailable to the public at any reasonable price. This is where most analysts make their fatal mistake. They assume demand grows at 3 to 5% annually, smooth, linear extrapolation. But reality moves in step functions, not lines. Solar didn't grow gradually, it doubled. EVs didn't creep in, they flipped entire markets. AI didn't emerge slowly, it detonated. We've seen this before. Palladium went from $200 to over $3,000 when automakers switched catalysts. Lithium went from $7,000 to $85,000 per ton when EVs scaled. Those were not bubbles. They were supply shocks. Silver's fundamentals are stronger than both. It has multiple industrial demand drivers, monetary history spanning thousands of years, a supply base that cannot respond quickly, and now, the wealthiest corporations on Earth competing for it. A move from $62 to $200 is not extreme. It's conservative. That's barely a 3 repricing, far less than historical industrial metal shocks. And this is why Oracle's December 2024 earnings mismattered. It wasn't about cloud growth. It wasn't about competition. It wasn't about execution. It revealed a truth Wall Street still refuses to price in. The AI future is constrained by physical reality. You cannot program your way out of a power shortage. You cannot print battery materials. You cannot digitize a depleted mine. Oracle couldn't scale because the grid couldn't support it. The solution requires energy storage. Energy storage requires zinc and nickel. Zinc mining produces silver. The system is tight. The buffers are gone. Something must give. And when commodity markets finally acknowledge that imbalance, price doesn't adjust politely. It moves violently. As of Friday, December 13th, 2025, silver closed near $62, just off all-time highs. Algorithms are trading charts. Retail watches headlines. But the capital that understands infrastructure, physics, and supply chains is positioning quietly. Oracle told the future a year ago. Most people didn't listen. The only remaining question is simple. Will you understand what's happening before the market is forced to?